Greetings traders and welcome back to another survival guide. Chris here bringing you some more information that will hopefully give you that competitive edge that you're looking for to have your way with the market, or if your goal is grander and you want to become a professional funded trader by passing the Gauntlet Mini, well hopefully this will help you along that road to doing just that. Today's subject will be based around what volatility is as how it pertains to the markets. Every market in the world since the beginning of time has exhibited some type of volatility. So we're going to talk about what volatility is, how it can be measured, and why it should be important to understand as a trader. Now, before we do that, if you can, do me a favor and click that like and subscribe button down below. That way I can keep coming out with this informative content for you guys, and maybe one day I will be trading right along by your side if you pass that Gauntlet Mini. Without further ado though, let's dive on into that material and learn a thing or two about volatility. Bzz. Market volatility, alongside liquidity, is among the most essential characteristics of the financial markets. Investors often use liquidity and volatility as a measure to give an indication of the overall health and the risk-return potential of a particular instrument that they're looking to invest in. And to do this, they generally focus on different market volatility indicators like the beta or the VIX. Let's go ahead and cover first, though, exactly what the definition by the textbook of market volatility is. Volatility measures the dispersion around the mean return of a security. We can describe it as the continuous up or down movement, which is key to understand because it is the jitters in the market's price itself that really describes what volatility is. It's the ups and downs and the distance between those ups and downs, as well as how frequent they are. Volatility indicates how the asset has performed compared to its historical average, and we use that to get an idea of how risky, so to speak, something might be to invest in, or potentially, in that regard, because risk is correlated to reward, how much our reward potential might be as well. Usually this is done by comparing whatever it is that we're analyzing to a leading market index, like say the S&P 500. Market volatility doesn't measure direction per se, but instead it's measuring the scale of those price swings. There are two main types of market volatility. We have historical and then we have implied. Historical volatility measures how volatile the particular asset was in the past. Implied volatility indicates how unstable we expect it to be in the future. Market volatility can depend on several factors, including the asset specifics, the current market environment, the market participants' behavior, and just even more than that. Usually, leading markets like the S&P 500 or the DJIA aren't volatile per se in relation to the smaller markets out there, and as such, they are generally used as a benchmark. Many instruments start to experience higher volatility usually when something isn't right in the market, or when there's not enough market participants in whatever asset that it is that we're investigating. Price behavior triggers can be caused by a looming crisis, a momentum flash crash, or breaking news, or even just asset-specific events. The general perception is that high volatility is a bad thing. However, this isn't always the case, and it just purely depends on the perspective of the trader. A higher volatility means a riskier market and more frequent and significant price changes over a shorter period of time. Some traders choose to specialize in trading when the market volatility picks up because this is what their strategy prefers. When that momentum for those swings come, they look to capitalize on those short-term spikes, both up and down. However, it's really difficult for beginning traders that are just getting into the trading world to attempt to take advantage of volatility usually in their favor. It's more commonly accepted that a beginning trader should trade in markets that are less volatile than those that are more volatile if they are planning to get their feet wet per se and have a bit of a slower and quote-unquote safer start, so to speak, into the markets, even though all type of investing absolutely can be risky. Market volatility is important because it's giving us a general sense of an overall market stability. It's letting us know how solid something is that we're investigating. Understanding the concept of this can help us better interpret the current market conditions. The basic conclusion that we're trying to draw is whether it is more or less risky to participate in a particular trade by paying attention to the volatility that's currently being exhibited. We can also construct a portfolio for ourselves that is a better fit for our personal growth objectives if we have a better understanding of what volatility is and know better how to measure it. Volatility itself is also essential because it indicates the current, historical, and future state of the market. It lets us know whether or not it's ripe for an investment at the moment. We can also learn from volatility how an asset might be changing over the years. For example, after introducing a new instrument or asset class, its price usually is more volatile on its first few days of market activity. As the market starts to mature, however, the fluctuations generally get lower and less frequent. Of course, this isn't always the case, and some assets are just more volatile by default. We typically associate volatility with fear, and this is because it tends to grow during downside markets when investors become more scared of losing their capital. Although very related, volatility and risk are not the same things. For example, for long-term investments, risk matters quite a lot, while volatility is really just considered to be noise. Although volatility is a vital factor to consider when we're evaluating something to invest in or open a position in, it shouldn't be the sole basis for a decision. We want to think of it as a measure of short-term uncertainty for those future expectations that we might have over this asset while our investment is running. Let's talk about the calculation that goes into quantifying how volatile something really is. Volatility is generally calculated as standard deviation with variance squared, and it signals how tightly the price is grouped around the mean or the average of the situation. So the way that we calculate this is by finding the mean. So we want to make sure that we're doing our work if we're doing this by hand on a spreadsheet, because it'll make our job a lot easier with spreadsheets nowadays automatically doing calculations for us. And the idea here is that we're going to add all the prices together, then divide them by the number of periods that we're analyzing. Then we want to calculate the difference between each closing price and the mean. Remember, the mean is what we figure out during step 1. So the next step is to calculate that difference between the closing prices and the mean. Then for step 3, we're going to go ahead and add the squared deviations, then divide them by the number of periods. At this point, we'll then have an idea of how volatile the number is based on a representation of how separated all of these numbers in between have become. The difference between calculating historical and implied volatility, it just simply lies in data. For the former, meaning the historical volatility, we use a series of past market prices, while for implied volatility, we use the market price of a market-traded derivative like an option, and this helps us get an idea of where something might be going based on those future prices. For a more straightforward calculation of implied volatility, investors often use the Chicago Board Options Exchange Volatility Index. For short, we call it the VIX, and we'll talk a little bit more about that later on. Some tips for trading in volatile markets. The most important piece of information that I can possibly share with you is to remember that the biggest enemy of your portfolio is not volatility itself, but it's your emotions. It's how you're reacting. Nothing can make traders doubt their strategies more than a market with extreme volatility. Once the price goes out of bounds, market participants might begin to question their approach and begin reconsidering whether they should retain their open positions. We always want to bear in mind that because the volatility is really not the enemy, instead it's our emotions, we want to really do our best to keep our emotions out of it. If we can't withstand taking a 30% or a 50% hit on a position during a volatile bear market, then we should consider closing that position if we're anticipating that volatility coming. It sounds simple, but we don't always know when volatility is going to be there. But why better being familiar with what causes volatility, we can then better be prepared for when it's coming, and then we can be more calculated with whether or not we want to leave our positions open or temporarily close them out and look to reopen them after that volatility passes. The best thing that we can do is just simply not get carried away with any kind of disastrous mental image when that volatility does arrive if we are still involved. We want to hold fast to our knowledge and our information that we've calculated with our strategy, with the resources that we've generated over hopefully a long period of time and a large sample set of data, and we don't want our foundation to be shaken all to bits just because we had a period where the market got a little bit wild and all of a sudden we started second guessing everything that had been working for years, all due to what has happened in a period of weeks. While we can't completely avoid volatility because it is an integral part of how the markets work, there are varying degrees of volatility like we mentioned. Some days it might be higher, some days it might be lower. On certain assets it may be higher here, and on other assets over there it may be lower. So what we need to understand is that we're not looking to avoid volatility, but instead we're looking to find a way to reduce its negative impact against us as traders. And one of the ways that we can do that is by making sure that we backtest our trading strategy in volatile market conditions before we take it live. That way we'll have an idea of what to expect when those unsuspected volatile moments happen while we are trading. Another way to reduce the impact is by sticking to our strategy that we did and planned ahead of time. It sounds simple, but a lot of traders really struggle in this discipline area. If we did our research and we proved that our strategy can work in volatile markets, don't get scared just because it currently in the very short term is not giving you the results that you want. Another thing that we can do is we can keep a trading journal to see how we've navigated previous volatile periods and seen what the outcome has been. So by logging when we experience volatility, that can help us as we go forward. Another way we can reduce volatility's impact is by reducing our position sizing and targeting smaller profit goals when we realize the market is becoming more volatile. And something else we can do is by not sticking to just the fundamentals. The fundamentals aren't always reliable, and sometimes during those erratic and volatile markets, the fundamentals really don't help us nearly as much as technical analysis might. We want to focus more on the charts and less on those short-term indicators. We want to pay attention to what's actually happening in the bigger picture when those volatile events happen and focus on the longer-term picture, because at the end of the day, volatility really is something that is more akin to short-term fluctuations and short-term noise. We also want to analyze our setups on multiple time frames. If we see that we have good logical signals on all time frames, even if the market conditions are volatile, we will give ourselves a better indication and a higher level of confirmation that just because we found a short-term signal that's in a volatile market, that it's a more intelligent idea if it agrees with a longer-term trend as well. And another thing that we can do to reduce volatility impact is by being careful with leverage. And this can't be overstated. Leverage can be awesome because it can allow us to gain a lot more money than we would with our own actual monetary amount. However, remember, leverage can also multiply our losses, and during those extremely volatile periods, using leverage can oftentimes turn out quite detrimental for the trader. There are two basic types of market volatility indicators out there for you to choose from, amongst others, but the most common exist with beta and the CBOE volatility index, otherwise known as the VIX, which we mentioned earlier on in this video. With beta, this is something that is going to measure the instrument's historical volatility in context of the S&P 500 index. The indicator is used mostly to quantify the past price fluctuations of those individual stocks. If the beta is greater than 1, then the stock's past performance is considered to be more volatile than the S&P 500. Alternatively, if the beta is less than 1, this indicates that the company is less volatile than the benchmark of the S&P 500. Once again, this obviously applies to the stock market because we're taking a look at the S&P 500. However, it is still a valuable thing to be aware of, regardless if you're a futures trader or just simply a stock trader. Then we have the CBOE volatility index, the VIX over here on the right. This is something that reflects the expected volatility of the whole market itself over the next 30 days. It's referred to as a fear gauge. And again, it is something that is trying to signal how confident or cautious investors are about these upcoming market developments that they're expecting. The VIX uses the prices of a basket of put and call options, like we were mentioning before, where it's using options to get an idea of what to expect in the future. Historical evidence has shown that when the VIX rises, the S&P 500 typically drops and vice versa. The absolute value of the index isn't as crucial as its general trend. So if the VIX is going up, it usually means that investors are more worried about those future price movements, and the opposite holds true if the VIX goes down. So this is something else that we can be aware of in concepts of tools that can help us get an idea of overall market sentiment and overall market volatility. So to sum things up, while liquidity is something that tends to measure how solid an asset is, how smooth something is moving, volatility is something that measures how jumpy something might be. How drastic are those gaps in between price? It's important to understand how to measure volatility and to understand why volatility is something that needs to be part of your consideration when choosing to trade anything at all. It doesn't matter if it's stock, it doesn't matter if it's futures, it doesn't matter what it is. You should have an idea of what to expect and how drastic some of those price swings will be. But until next time, thank you for joining me as always, folks. I wish you best of luck in your market endeavors, and hopefully I'll see you on the other side when you pass that Gauntlet Mini. See you soon, folks.